Welcome back to Retirement News Online. I'm Scott Drake. When someone starts income planning in retirement, usually that income is going to be coming from different sources. It would be great if at least one of those sources was tax-free. Here to talk about this topic is my guest, John Kelly with Kelly Financial Services in Chicago. John, welcome back. Let's start out with a Roth IRA, a very common strategy. A lot of people, I guess, just think that the Roth IRA is tax-free. You just pay tax up front.
No, it's not, and there are several better alternatives out there, but again, it depends, and everybody's situation is different, Scott. So we have to sit down, take advantage, take a look at what their current situation is. In fact, a lot of the stuff we've been doing right now has been around for over 15 years, and it falls under the IRS code section 7702 or 72E, and a lot of advisors don't even know about it. A lot of tax preparers, we train tax advisors all the time on this, and what it allows you to do is take the money you've maybe saved in your 401k or your IRA. For most people, the bad news is it's all taxable. The good news is you have an IRA and a 401k, but guess what? You also have a partner there. It's called the government. So through this section 7702, we're able to transfer that money, get the taxes paid through this instrument we use for our clients that gives them tax-free income, tax-free death benefit, and also long-term care benefits while they're alive. And they can never outlive the income.
Well, that sounds really interesting, John. Can you kind of give us an example of what this would look like with a client?
Well, Scott, I had a client that came in a couple of weeks ago. The guy was going to be retiring in the next month. He was working with his current advisor. He had over $1 million in his 401k plan, and he wanted to convert it to a Roth. He had a pension through his company. He's also going to have Social Security. His wife is younger and she's still working, so they didn't need the income. So a Roth conversion seemed like the correct strategy for him. Through section 7702, however, I was able to show him how we can do the exact same strategy, convert the 401k from a taxable entity over the next 4 years. Through the IRS code 7702 or 72E, what we're able to do is we're still going to be able to convert the taxable 401k, but we're going to do it over 4 years. The client does not have to pay any taxes out of his pocket like he would with the Roth conversion. The instrument we're going to put it into is going to pay them taxes through participating loans. So say, for example, he's paying $80,000 a year in taxes. Well, he is still earning interest on that $80,000, even though it's sent to Washington to pay them taxes over the next 4 years. The nice thing about it is he's going to get a guaranteed 2% floor, 17% cap. We're going to create a tax-free death benefit, almost $1.9 million for his beneficiaries should he pass away prematurely. He's going to get a guaranteed lifetime income, tax-free for him during his lifetime. And we're also going to protect him for long-term care, for a catastrophic illness, whether nursing home health care. That's the thing that Roth conversions do not allow you to do. And this is a strategy that's been around for almost 15 years. And we train a lot of tax advisors on this, and most financial advisors don't even know about this, but it's been around, like I said, for almost 15 years.
Great job, John. Thanks again.
Thanks for having me, Scott.
Guest has been John Kelly with Kelly Financial Services in Chicago, Illinois, and you're watching Retirement News Online.